If you are collecting Social Security right now, there is something the IRS has been quietly doing for decades that is costing millions of retirees real money every single year, and most of them have absolutely no idea it is happening. It is not a new tax, and it is not a penalty, and it was not announced at any press conference you might have seen on the news. What it is a rule that was written into law back in 1984 and then expanded in 1993, and has never once been updated for inflation since the day it was created, which means that every single year, more and more retirees are being pulled across an invisible income line that triggers a federal tax bill on the Social Security benefits they worked their entire lives to earn. Here's what makes this so frustrating for so many people. When this rule was first written, it was designed to only affect high-income households, people with significant investment portfolios and large pensions who did not really need their Social Security to get by. And that was the intent. But because the thresholds in this rule have never moved with inflation, they now catch people at income levels that back in the 1980s would have been considered completely middle class. And right now in 2026, with benefit amounts higher than they have been in years after 2 consecutive cost of living increases, more retirees are crossing that line for the very first time without any warning at all. There was also a new tax break passed for seniors last year that can help offset some of this, but the details of who qualifies, how much it actually helps, and where it falls short are confusing a lot of people right now. And getting those details wrong could cost you. Your tax situation as a Social Security recipient may have changed, and if you're not aware of these rules, you could owe more than you planned for this year. Before we go any further, I want to be straightforward with you about one thing, because this topic has a way of making people nervous, and that is not what we are here to do. This video is not about scaring you, and I'm not going to tell you that the government is taking your benefits or that your check is disappearing, because none of that is true, and you deserve a straight explanation without the drama. What I'm going to do is walk you through, in plain everyday language, exactly how Social Security benefits get taxed, why the rule catches so many retirees by surprise, what the new senior deduction actually does and does not do, and what steps you can take to make sure you're not paying more than you owe. Because here is the truth about who gets hurt by this rule most often, and it is almost always the people who simply did not know it existed. The retirees who assumed their benefits were either taxable or tax-free and never knew there was a formula in the middle that depends on all of their income sources combined. The people who took a required minimum distribution from their IRA and had no idea it could push their Social Security into taxable territory. By the end of this video, you will understand how the formula works, what the thresholds are, and why they matter right now in 2026. How the new deduction affects you depending on your income level and what you can actually do about it. All in plain English with no guessing. Let's step back and make sure we are starting from the right place, because a lot of people carry one of two assumptions into this topic that are both wrong, and clearing those up first makes everything else much easier to understand. The first assumption is that Social Security benefits are always completely tax-free, which is not true for everyone. And the second assumption is that Social Security is always fully taxable, which is also not how it works. The truth is that whether any portion of your Social Security gets taxed depends entirely on a specific formula the IRS uses, and that formula is based on what they call your provisional income, which is a number that does not appear anywhere on your bank statement or your benefit letter, and is not something most retirees ever calculate on their own. Here's how it works. You take your adjusted gross income, which includes things like pension payments, wages if you're still working, IRA or 401k withdrawals, and investment income. And then you add any tax-exempt interest you received, such as interest from municipal bonds. And then you add half of your total Social Security benefits for the year, and that combined total is your provisional income. The IRS then compares that number to fixed dollar thresholds that have not changed since the 1980s and 1990s. And based on where your provisional income lands relative to those thresholds, either none of your benefits are taxable, up to 50% could be included in your taxable income, or up to 85% could be included. And that is the key word, included, not taken, because what becomes taxable is simply added to your total taxable income for the year. And then your regular tax rate is applied to that amount, which is an important distinction that many people misunderstand. That is the foundation. And now that you have it, the rest of this is going to make a lot of sense. Let's get into the numbers, because this is where the real picture comes together. For single filers, if your provisional income is below $25,000, none of your Social Security benefits are taxable at the federal level, and you owe nothing on them, period. If your provisional income is between $25,000 and $34,000, up to 50% of your benefits can be included in your taxable income. And if your provisional income is above $34,000, up to 85% of your benefits can be included. For married couples filing jointly, those same thresholds sit at $32,000 and $44,000. Now here's the part that matters most, and this is the part most retirees overlook entirely. Those numbers, $25,000 and $34,000 for single filers, $32,000 and $44,000 for couples, have not moved one single dollar since they were set in 1984 and 1993, and they are not adjusted for inflation each year the way standard tax brackets are, which means that as the cost of living rises, as benefit amounts increase with each annual COLA, and as retirees draw from retirement accounts they spent decades building, more and more people are drifting across those fixed lines without ever knowing it was happening. The 2025 cost of living adjustment was 2.5%, and the 2026 adjustment was 2.8%. And while both of those increases were meant to help retirees keep up with rising prices, a higher benefit amount means a higher provisional income calculation, which can quietly push someone over a threshold they were comfortably below just a year or two earlier. Here's where people get confused, and it is a really common misunderstanding. A lot of retirees assume that because their Social Security went up with the COLA, their financial position improved by that same amount. But if that increase pushed their provisional income past one of those thresholds for the first time, part of that raise gets taxed right back, and the net result ends up being smaller than they expected. And it is not just the COLA that can move you across the line, because any additional income counts toward your provisional income calculation, including pension payments, IRA and 401k withdrawals, capital gains from selling investments, and even interest income from a savings account, which means that a single financial decision made during the year, like taking a larger distribution to cover an unexpected expense, can have consequences at tax time that you were not prepared for. Let me put some real numbers to this so you can see exactly what it looks like in practice. Say you are a single filer, and your Social Security benefit for the year is $22,000, and you also have $21,000 in other income from a pension and a small IRA withdrawal. Your provisional income is half of $22,000, which is $11,000, plus $21,000 in other income, giving you a total of $32,000. That sits above the $25,000 lower threshold, which means up to 50% of your benefits can be included in your taxable income. And depending on the exact calculation, that could mean over $1,000 added to what you owe. Now, push that same scenario slightly further. Same person, same Social Security, but your other income rises to $28,000 because you took a larger IRA distribution to cover an unexpected expense, pushing your provisional income to $39,000, above the upper threshold of $34,000. And now, up to 85% of your Social Security benefit is in the taxable column. On a $22,000 annual benefit, that is $18,700 added to your taxable income. And over 5 years in a similar situation, that adds up to a significant amount that most people never saw coming. Now let's talk about the new development that has brought both some real relief and a fair amount of confusion for retirees in 2025 and 2026. The One Big Beautiful Bill Act, signed into law in July 2025, created a new additional deduction of $6,000 for taxpayers who are 65 or older, and it is available whether you take the standard deduction or itemize. And for a married couple where both spouses are 65 or older, that is $12,000 in additional deductions on top of everything else that was already available. For lower-income retirees, this is genuinely meaningful relief, because stacked on top of the standard deduction and the existing extra deduction seniors already had, it can bring your taxable income down low enough that even if some of your Social Security is technically included in your taxable income, the deductions absorb it, and you end up owing very little or nothing at all. But here is what you need to understand clearly before you assume this takes care of everything for you. First, this deduction is temporary, and under current law, it is only available for tax years 2025 through 2028, after which it expires unless Congress votes to extend it. Second, it phases out for higher earners, beginning to reduce for single filers with modified adjusted gross income above $75,000, and for married couples above $150,000, decreasing by 6% for every $1,000 your income exceeds those limits. Third, and this is the part that trips people up the most, the deduction reduces your taxable income after the provisional income calculation has already been done, which means it does not prevent you from crossing the provisional income thresholds that put your benefits in taxable territory in the first place. You can still cross those thresholds, still have a portion of your benefits counted as taxable income, and then use the deduction to reduce your total tax bill on the back end. And for many people, the net result is little or no tax owed. But for those with moderate incomes just above the phase-out limits, the relief is partial, and a surprise bill is still very possible. The bottom line is that knowing your provisional income before you take distributions gives you options that you simply do not have after the fact. Before we move on, there is something important I need to address directly, because whenever there is news about taxes and Social Security, scammers use that confusion as an opening. And right now, they are absolutely doing exactly that. People are receiving phone calls from individuals claiming to be IRS agents, telling them they owe back taxes on their Social Security benefits and threatening legal action or even arrest if they do not pay immediately. And I want you to be completely clear on this. Those calls are scams every single time, without exception. The IRS does not call you out of nowhere demanding immediate payment, and they do not threaten arrest over the phone. And they will never ask you to pay anything using gift cards, wire transfers, or cryptocurrency. So if you receive a call like that, hang up immediately without giving any information at all. The IRS always contacts you first through official mail sent through the United States Postal Service. And if you receive a letter and want to verify it is real, you can call the IRS directly at 1-800-829-1040 using a number you look up yourself at IRS.gov rather than any number provided by the caller or the letter. Be careful with emails and text messages as well, because the IRS does not initiate contact through email, text, or social media. And any message claiming to be from the IRS about your benefits or taxes should be treated as suspicious until verified through the official website. Please share this with the people around you, because these scams target older Americans specifically, and they are effective precisely because the topic of taxes on Social Security is confusing enough that a confident-sounding caller can seem credible, and your awareness right now could protect someone you care about from a real financial loss. So, let's get specific about who is most at risk right now and what you should actually be doing in the coming days. If you are a single filer and your provisional income, meaning your AGI plus tax-exempt interest plus half your Social Security, lands anywhere between $25,000 and $50,000, this rule is actively affecting you or is very close to doing so. And the question is not whether you knew about it, but whether you are withholding enough from your benefits throughout the year to cover what you will owe in April. If you are married filing jointly and your combined provisional income is anywhere between $32,000 and $70,000, the same applies to you. And the concern is even sharper for couples because the thresholds for joint filers are only modestly higher than for single filers, which means 2 Social Security checks combined with 2 retirement accounts can cross the upper threshold faster than either spouse would expect. The retirees most caught off guard right now are those who recently began taking required minimum distributions from a traditional IRA or 401k for the first time, because those distributions add directly to your AGI and can push your provisional income above a threshold you were comfortably below in prior years, with no warning from the SSA or the IRS. Here's what I want you to do this week. Pull out your most recent SSA 1099, take half of your annual benefit amount, add it to your adjusted gross income and any tax-exempt interest, and compare that total to the threshold for your filing status, because knowing where you stand is the first step toward doing anything about it. So here's what this really comes down to, and let me pull it all together clearly. The IRS uses a formula based on your provisional income, which is your adjusted gross income, plus tax-exempt interest, plus half your annual Social Security benefit, to determine whether any portion of your benefits are taxable. And the thresholds that trigger taxation, $25,000 and $34,000 for single filers, and $32,000 and $44,000 for married couples, have not been updated since 1984 and 1993, which means more middle-income retirees are being pulled into taxation every year simply because their benefit amounts rose while those fixed lines stayed exactly where they were. Up to 50% of your benefits can be included in taxable income if your provisional income is between the lower and upper threshold, and up to 85% if you are above the upper threshold, and that included amount gets taxed at your regular income tax rate. The One Big Beautiful Bill Act signed in July 2025 created a new $6,000 senior deduction for filers age 65 and older, available from 2025 through 2028, and it genuinely helps many lower and moderate income retirees, but it phases out for singles above $75,000 and couples above $150,000, and it does not change the provisional income thresholds themselves, so it reduces your tax bill on the back end, but does not stop you from crossing the line in the first place. If you recently started required minimum distributions, had a one-time income event this year, or your COLA increase nudged your provisional income close to a threshold, check your numbers before tax season arrives, because adjusting withholding or managing distributions works best before the year closes. And one final thing to carry with you. The IRS will not call you demanding immediate payment on your Social Security taxes, and anyone who does is running a scam. So hang up and verify everything through irs.gov or by calling 1-800-829-1040 directly. You earned these benefits, and you deserve to understand exactly how they are treated at tax time so that nothing catches you off guard and nothing gets taken from you that you did not actually owe. That is what this channel is here for, covering Social Security rules, IRS guidance, Medicare changes, and benefit protection in plain language every single week so you always know where you stand. If this video helped you understand something you were unsure about, please subscribe so you never miss an important update. Take care of yourself, know your numbers, and we will see you in the next one.